intro. Take it away.
Well, good morning, everybody, and thanks very much for joining me and us. So I'm Stephen Millard from Notion Capital. We're a London-based European SaaS VC. Kind of three things you should probably know. We're operator and entrepreneur-led. So the founders of Notion Capital built a SaaS company. It was the third company they built, which was, when it was acquired by Symantec in 2008, was the second biggest SaaS company in the world, second only to Salesforce. That business was a company called Message Labs. It still continues as part of Symantec Cloud. That was a great outcome. It was 150 million turnover business. And since 2009, we've been investing in SaaS companies, so operator-led, SaaS-focused, and we have an ethos of value add. You know, how do we support our portfolio companies to fulfill their potential? And that's our kind of core differentiation right there. You know, we only do SaaS. We've all worked in and led SaaS companies, and we double down on supporting our portfolio companies to build amazing companies. I've been doing that with Notion since early 2016. So personally worked over that time period with probably 80 SaaS companies. We're currently raising our fifth venture fund. We have a super early stage angel stage fund, which does about 50 deals a year, sub 100K. We have a core venture fund, which does 4 to 5 investments every year. We're raising a fifth version of that at the moment. And we have a later stage fund for investing in our own portfolio. One of the things that's been most interesting is that when I think about all the SaaS companies that we've invested in, they're all different, but they have a huge amount in common. And those commonalities allow us, I hope, to help them to avoid the mistakes that many companies make, and to kind of build the capabilities that will help them to grow. I've been working in enterprise software for a long time.
Awesome. So to set the scene a little bit, we've spent this week as founders making sure that we're building products that users love. On Monday, Seb talks about it from a product-led perspective, but Stephen's going to talk about it a bit from an investor's perspective. So to get the ball rolling, from your side of the table, what does good beta traction look like on the whole? And then we'll go into a bit more detail.
Yeah, I think it's you have to put these things in context, right, of the decisions that we're making as early stage investors, and we put far more emphasis on some of the qualitative things rather than the quantitative. I think it's fair to say that the essence of this stage, as far as we're concerned, is are you solving a problem that's truly worth solving? And that's where the discovery comes in. That says, and through the research that you're doing, and I'm a big fan of customer development, and if you haven't read Cindy Alvarez's book, which is called Customer Development: How to Build Products Customers Will Buy, you should do. Cindy is an extraordinary individual who's built her entire career at Microsoft and GitHub. I can't remember where she is now. I think she might still be with Microsoft. It's done a few sessions for our portfolio in terms of extracting how you ask really good customer development questions. And so what we're looking for in terms of the outcome of this phase is you've ascertained that the problem you're solving is the most important problem you can solve for the customers you're choosing to serve with the greatest amount of value and impact that you can possibly demonstrate. And that you've gone round a circular process, if you like, of talking about those things. Hey, this is the problem we solve. This is who we solve it for. And this is the impact that it delivers. But I think what's more important than the data that we want to see is that you've gone through that kind of process of reflection that says, and I want to put my life on the line for the next 10 to 15 years to build a massive company. Because that's what's really important at this stage, especially if you want to go down the venture capital route. I was just talking to the CEO of Muse, right, which is a Prague-based I'll try and give you an example. A Prague-based company which provides hotel property management systems. They are approaching 100 million of ARR. They've been at this for 10 years, and it's been hard graft all the way. And they've probably got another 5 years until they achieve some kind of realization. And so that's the question that's most important, I think, that you need to answer, is answering it yourself. I firmly believe this is a problem that needs to be solved. I believe I'm the right person to solve that problem. And I believe I can execute upon a strategy to commercialize this to a massive scale. And it's worth something I'm feel confident putting my life on the line for. And when we think about what's really interesting is when we look at the companies, many of the companies we're investing in now, they're solving harder and harder and harder, more and more valuable problems. So banking as a service might be a good example. And we invest super early, like pre-validation with companies where there's an exceptional founder problem fit. And there's an exceptional correlation between the problem that they're solving and the value that they can create. So it's hard to give you kind of real kind of, hard data. The more you can give us any evidence that will allow us to say that there is an MVP and there are customers and users who are giving you positive engagement, that's a good thing. If you can prove someone wants it and someone is prepared to pay for it, that's better still. But we're really not making decisions based on that. If we're an investor at this stage, and that's really all I can talk to, I've never worked at another VC, right? We're making decisions based on you and the scale of the opportunity. And we use signals to allow us to validate, is this a good investment opportunity? Do you have a co-founder? Have you done this before? Have you done this before and been successful? Have you done this before and been successful in this domain? Have you attracted other angel VCs who we believe are, tier one angel investors? We don't expect a huge amount in terms of evidence and data, but we use third-party signals rather than necessarily the pure discovery data. It's not really answering your question, I appreciate that, but it's kind of the best answer I can give you kind of at this stage in terms of it, because I'm thinking about it from the perspective of would we invest?
Stephen, I have a question on founder market fit, shall we say, or founder product fit. If
Yes.
You don't have, let's say like you don't have a PhD, a doctorate's degree, you don't have loads of experience in a certain field, but maybe you have a unique insight. Is there still a way to prove to you and other early stage investors that you are the right person to start a company in that space?
Yeah, I mean, look, these aren't absolutes, right? Okay, but they are shortcuts. Because especially if you're thinking at this kind of early stage, yeah, I mean, it's good, to see 50 company, we're probably talking, 500 or 5,000. We've got a machine that's spitting out potential investment opportunities for us based upon data and insight. And then we attribute kind of scores to those. And like most VCs do this, right? So I'm not talking kind of particular rocket science. We are looking for things that will allow us to de-risk a decision. And so, yes, if you've got domain experience, that's good. It actually doesn't always necessarily correlate with great success, right? So I'm not saying it's an absolute must-have, but we will look for, especially at this early stage, co-founders, repeat experience, STEM background, angel investors that give us confidence. I think the best way you can demonstrate it is through kind of traction and engagement, for sure. But invariably people are, especially if you're doing something that's really difficult and complicated, it needs to be something where you can demonstrate a good understanding of how that industry works and how it should work, right? That's really hard to do without kind of a deep insight into that industry, unless it's something fairly generic, and in which case that's probably less interesting. Does that make sense?
Yeah, it absolutely does. Paddy, what was the next question you had?
So a bit about kind of get, keep, and grow. So we've heard from a few other investors that there's customer acquisition and then there's customer engagement, and that investors like to see engaged customers, people that are coming back. And so do you have any advice on what that looks like if someone was putting that on a deck, or how to demonstrate that you're kind of keeping and growing customers rather than just constantly acquiring new customers, but then they get dropped off?
Well, I mean, obviously that this becomes more and more important as the company matures, right? So if I try and characterize it, and then I'll try and kind of unpack that a little bit. So, and I'll just use some shortcuts, right? Like 0 to 1 million in revenue. Okay, all that you are trying to do, and I keep saying this, is convince yourself, right, that this is something worth doing and doing for the next 10 to 15 years. I know I've set up businesses. I've set up one business which failed, which I know was a good thing to do, right? And I wish I'd made it work. And it would have been worth putting my life on the line for like 20 years to build a massive company. But I've built other companies or founded other companies where in hindsight, I go, do you know, I couldn't with all conscience say that was a business I would wanted to do for another 20 years. So I think that's the first thing. Once you've got that, I think then you go into a period, obviously what you might call product market fit. It's kind of like the 1 to 3. You know, can I zoom in on a set of customers who believe what I believe, right? Common set of customers buying for a common need with a common proposition, with a similar kind of journey, and might be users, not customers. And so it's hard to say about engagement because, you know, and people buying more until you've been through a buying more cycle, right? What I would advise, though, in that instance, is you can, to a certain extent, manufacture that, whereby you're selling for a low average selling price to customers who have a high potential ACV. And so that land in order to expand is a really good way to create kind of the FOMO amongst VCs. And we've seen quite significant shifts here. This is all about kind of typically product user-based pricing or consumption pricing kind of models, where people are paying more as they use more. And where we see often the best success there is a really small landing kind of footprint of an engagement with a customer, and then demonstrable ability to support them to be successful, and they buy more and more and more. So what we would call the kind of net revenue retention is growing. But I mean, I would imagine that's a bit beyond all of you at this stage, because you're not there. And so it's a bit disingenuous to say that's what we're looking for, because it doesn't exist. And then as we go further along, I mean, there's different kind of evidence, because we typically are investing at like 1 to 3 million of ARR. That's our core sweet spot. I mean, we do those 50 times 50 to 100K checks. But most of them, we don't have that evidence.
Yeah. Is there
We're
anything
not investing based on that?
Is there anything that people at the very early stages think that they need to show you, but actually you don't care about at all? Like, is there particular like metrics or things that like people are chasing, thinking it's the right thing to show investors, but actually they could be spending their time doing something that's far more valuable?
Well, I do. You know, I've been as guilty of anybody as creating a spreadsheet, you know, that says this is what the revenues are going to be, and then dragging the cells across to the right. They get bigger and bigger, right? You know, it's just not beneficial. It's not useful. It's not interesting. Top-down budgets, where we're saying, okay, that's the size of the market, and if we get the 1% of that, you know, then you know, we built a massive company. Personally, I think I just ignore that entirely. You know, I think there's a lot of extrapolation of future scenarios. You know, there's one thing we know for sure. You know, humans are very bad about making predictions, especially about the future. The only things that you can evidence are the things that are right in front of you right now. You can evidence to a certain extent your understanding of the life stages you're going to go through a business. The biggest red flags, I think, are people trying to scale too fast. You know, if I think about those life stages, kind of 0 to 1, 1 to 3, and 3 to 10 onwards, the fundamental essence is one of kind of iterative improvement and increasing confidence in terms of ability to deploy resources. And so, sorry, I'm kind of dancing around the question. I think it's the extrapolation of the future that personally, I think at this stage is unhelpful. What I want to understand is this is a really important problem that is really valuable and yet hard to solve.
Okay,
and that's what I want to see.
I have 2 follow-up questions off that. So one situation that I know a lot of founders face is hearing VCs say they know forecasts are kind of BS, but at the same time, they want to see a 1 to 3 year forecast. And so obviously maybe 1 year is okay if you have a product launch and you can do something around like the current contracts you have, it might be manageable. But for those VCs that still want to see a 3 year forecast, what's the best way for founders to handle that? And then also
qualify them out, because they don't understand what they're doing.
What do you think?
It's as important that you qualify your investors as they qualify you. We did a hacking VC event a couple of months ago with Ben Simpson at Easel. I mean, the guy's amazing. I don't know if any of you have come across him. He's creating a platform for creators, experienced creators. Really exciting business. And he just like, okay, I've given you the 30-second pitch. Is this something you could you offer a term sheet as a lead? If not, I'll get back to you in kind of like, when I've got the lead. Doesn't send decks, he doesn't send them any information, and he kind of corrects the FOMO. I would qualify hard. I mean, I would qualify hard in terms of so many questions people don't ask their VCs. I can go through that separately, but
I've heard some VCs say, though, that they ask the 3 year forecast, not for like financial projection reasons, but more to assess the, ambition of the startup and where the focus is. And so do you think, would you still push back on that? And then my other question was, and you've touched on this a little bit before, but saying that you really want to buy into the problem and that you feel it's a large enough market to create a unicorn company, or that is even of interest to you. How do you assess the problem, especially if you have a founder who has a grand vision, but they're starting with their MVP and they're focused on a really narrow part of a larger problem?
It's a good question. I mean, bear in mind, these are like foothills, right? Okay, so you've got to be solving a problem in a market you're making that is small. If everyone hasn't read Crossing the Chasm by Geoffrey Moore, like 1996, I think it was written, maybe 1997, it's still true, right? Okay, take a big market, make it really small, create a critical mass within that market before you move on. But it's adjacent to a massive market. I think what I would be wanting to evidence is that through the discovery, you're not just capturing, hey, this is a problem worth solving. You're not just capturing the kind of the features that they would use, but you're capturing their willingness to pay. Just how important. I mean, people don't ask these questions. They don't ask. Okay, that's really interesting. I mean, I did a discovery for one of our portfolio companies, a super early stage seed company that was doing synthetic data for financial institutions. And I got through to one of their customers. We were really struggling with them because they just couldn't find product market fit. And I'm not trying to kind of, there's no silver bullet, but I got through to I was talking to the technical director at a big bank and said, okay, it's really interesting. So you're using this product, but it's really in a beta mode. It's on a limited basis. what would you be willing to pay? Like, what would be a crazy amount, which would be way, way, way too much? You'd never pay for this product. And he didn't answer the question. And we kind of just ignored it. And I said, okay, what would be way too little that would really you'd have thought, well, this is just not worth it. And it's called a Van Westendorp technique, where you ask these kind of range questions. So at what point is it way too expensive? What point is it way too cheap? What point is it a little bit too expensive, a little bit too cheap? And he didn't answer. And we got through to the end of the conversation, and he said, I've been thinking about what you said, bearing in mind they were charging him 25 grand for the beta. He said, I think what you said, if they really, really did what they said they'd do, I mean, 8 figures a year, easily. So like a 10 million plus kind of ARR to solve that problem. So I think if you through your discovery process, you can be starting to understand willingness to pay, and you can be starting to evidence how and why people would buy and the value that they would create, then I think you're onto something very interesting there.
Awesome.
People don't ask pricing questions.
Yeah.
We're terrified of it because we feel that somebody's going to, show us for the charlatan that we are, and all of a sudden our amazing idea is not really worth it. I'd rather know earlier rather than later that actually I'm not really prepared to pay for this.
I've got 2 kind of quick fire questions, which are just common questions that people ask us all the time. So it'll be great to get your thoughts, and then we'll move to some of the questions in the chat. So if you want to say a quick hi to Stephen and ask face to face, raise your hand and we'll call.
There's some good questions in.
If not, we'll read them out from the chat. So 2 quick fire questions, doesn't need to be super long answers, but given what you're saying about, like some of these numbers that people present in decks being ridiculously high and not necessarily actually meaning anything, do you still need that slide? Like, would you, if you saw a deck and it didn't have like, say for example, total addressable market and that like classic 3 bubbles, would you be like, oh, they're missing that slide even though I'm not going to read it anyway? Like, is there a point having it even if it's pointless?
It's a good point. I don't honestly. I think there's a I need to know that you think, you believe, and have convinced yourself at least, right, that this is a massive market. So I guess you've got to put something in there, like a one slider.
Yeah.
They said, as to my point, was like, this is a really, really important problem. It's really hard, but it's really valuable to solve.
Yeah.
And if you can tell me that like the first 30 seconds, I'm going to be interested. And by the way, I've got some evidence to demonstrate that this is feasible. And remember, all we're doing is we're going to give you some money to finance an experiment, right? We know that the vast majority of investments we make fail. I'm sorry to say, especially at your stage, but also at our later stage, Series A and onwards, so that's all we're doing. We're giving you money for like 18 months to 2 years to prove an hypothesis. Yeah.
Another really quick question, which again is a common thing that comes up. So when you're looking at total addressable market, does it have to be like 1 billion plus for you to think, wow, that's a massive market opportunity? Like, is there a number when people put a total addressable market when you're thinking that's actually way too low, that even if they get a small segment, I'm not going to see a return?
Yeah, absolutely. I mean, you have to think about it from a mathematical perspective in terms of, what kind of business are we in, right? If you take money from a fund, like let's say for simplicity's sake, it's 100 million fund, right? And we will make, I'm going to put the angel stage, the kind of early stage investments to one side, because we don't think about our portfolio construction in the way that some seed VCs might do. So all of our Series A investments have to have the potential, when they may potentially realize their value in 8 to 10 years, to return the fund. We have to believe that at the point in which we're investing, because we know that only 2 or 3 of the companies will, probabilistically, out of 25 companies. And we don't know which 2 or 3 it is. Obviously, if we did, we'd be in a very different business. And so we have to believe it's possible. So we have to believe that, let's say, I mean, wow, if we ended up with 10% of a business, it has to be worth in and of itself $1 billion to generate 100 million return, which pays off the fund. So that's the simplest rule of thumb for any VC. When you go earlier and earlier stage, like a seed camp or a local globe, and we've got stellar reputations, right, of investing at seed stage, they are making a lot larger number of bets, because the chances of success are even lower. So in every seed camp in portfolio will probably be 50 companies. I mean, phenomenal hit rate. It's just extraordinary. But interesting, actually, just as a aside, if you talk to Carlos at seed camp, he only thinks about 2 things, right? The characteristics of the founding team. Do they understand the problem, and have they got the cohesion to last for 2 to 3 years? Because that gives me a great chance of success. And is this problem really valuable and worth solving? That's it. And they're bloody good at it. I mean, gosh, I wish I was an investor in seed camp. We were an investor in one of their previous funds, but we sold out. Such a big mistake. There are quite a few questions on here.
Should we go to some of the raised hands, and then we'll bash through any of the others afterwards? So, yeah. Anthony, do you want to go first?
Yes.
So
hello, everyone.
Speak of view, so I can see whoever's. Hi, Anthony.
Hello, Miss Stephen. How are you doing? Hello, Miss Alder. Hello, Miss Coyle. So basically, the question is: let's say that we go to a first meeting with an investor. Should we rather start pitching them, or we should focus more on building a relationship with them and getting to know them? Because essentially it's the first meeting, so we need to know their needs and what they and how they understand the whole. So yeah,
you do that work beforehand, right? Do your qualification and your discovery beforehand. Do the background reference checks, right? Talk to other people who know us, know what we like and what we want. Your objective in your first meeting is to get the second meeting. It's like sales, right? Okay. How do you do that? By turning their skepticism into greed. Okay. So Anthony this is really, really interesting. What the problem he has articulated. I would also encourage you to think about it in terms of there's classic kind of storytelling, right? In terms of what's the narrative arc you're going to take us on. And maybe if we've got time, we can maybe touch on some of that. But being able to tell the whole thing in 30 seconds. This is why I'm solving this problem, because it's so important and so valuable and so hard. And this is why I'm the right person to do it. And this is why you should pay attention. And then I can go into the deck, but do your discovery outside of that meeting.
Great. Thank you very much, Mr. Stephen.
That's all right.
No problem. Maya.
Hi, Stephen. So we're sort of planning our beta right now, and just some context. We raised some pre-seed earlier this year, so for us, we need to get to that next foothill. And so, as we plan our beta, should we focus more on monetization or acquisition? So we're B2B, enterprise, cybersecurity, a little bit of privacy, and so really, what sort of is those proof points that we've got through that first foothill and ready to start talking about a seed raise? It's
a really good question. I mean, I think engagement is a better way to think about it than monetization or acquisition, right? So There's a really interesting kind of part of Simon Sinek, something he says, which is, at this early stage, you've got to sell to people who believe what you believe, right? And so your challenge within this kind of early stage is say, can I find a common set of customers who believe what I believe and are willing to invest their time and hopefully their money, and in getting those people to engage with the product. I wouldn't obsess about the acquisition model until I've validated that part, because that's one of the biggest problems we see. If you start to focus on, okay, how do I now figure out how to find more and more of those people, and something where an acquisition model will scale. So the most important thing, I think, is the engagement, whether it's customers or users, and being able to demonstrate that through their usage that has been repeated, hopefully scaling, and demonstrable value that they're feeding back to you.
Can I ask a quick follow-up question then? Because we've got like a good, better, best sort of product-led growth motion, a lot of the feedback we've gotten from some of the other tier 1 funds has been, look, the key from them is validation and pricing, given that it's cybersecurity and enterprise. And so that's sort of really been sort of our gate to get to the next stage, is getting enough critical mass to say, actually, okay, we've got some early adopters and pricing is getting past procurement. And so that's really sort of where it sort of becomes it unlocks the next stage of the business.
Yeah, I mean, it's the single hardest thing, I think. I mean, and it's the most under-intellectualized and the most under-resourced and under-thought aspect of a go-to-market strategy is the pricing model. It's also the hardest thing. I mean, I know how early you are. I mean, you're going through commercial procurement processes. I mean, that you're coming to a point where you have to start to make some bets. The one thing is you don't know yet, and so I wouldn't worry too. I mean, do they pay? Yes, they're paying. Fuck, great. That's amazing. And is there a big? Sorry, pardon my language. Sorry. Is there a gap between the price you're paying and the value you're delivering? Right.
Oh yeah, we're leaving money on the table. Yeah.
So, but that's okay, right? At this stage, as long as you know that, if you've got people who are willing to pay, then that is clear evidence. And I would not try and create a baked pricing strategy at this kind of stage. I'd be asking those kind of questions. I'd be getting whatever the hell I can, right? I'd be thinking about the fact that I'm going to grandfather all that pricing anyway, because I'm going to be moving people onto a pricing model at a later stage. But I'd be obsessing about those questions and say, okay, I'm so delighted that you bought. Can I ask, right? First of all, ask why. So why did you buy? What value do you expect to see? And then later you can go through the value they've had. You can also ask them, how did the process actually happen, right? Who was involved? Obsess about those kind of discovery questions, not just the kind of the benefit type questions. And then ask, look, I hope you don't mind me asking, but look, what would have been a crazy price? What would have just been way too much? If you think about how much you spend on I know, one of your an alternative solution, or let's say Snowflake or whatever it might be, compared to what you pay to them, how much would you pay for this? And what you're trying to do is get those kind of framing questions. I think that's super interesting to be able to demonstrate, but don't try and create a baked pricing strategy at this stage.
Okay. Cheers. Thank you, Stephen.
That's all right.
Luciana.
Good question.
Hi, thank you.
Hi.
Thank you for the pieces of
nice
advice.
setup you got there.
Yes, thank you. Stephen, some pieces of the question I had, you already gave it. So the question is, imagine I'm your friend, a personal friend, and I'm telling you my business is about to launch next month. As a way of context, it's a legal tech company for contracts, targeting startups. So again, I'm your personal friend. I'm getting a VC meeting and I'm asking you for a piece of advice, like 3 things I should have no matter what for that meeting.
Well, that's a really That's a really good question. I'll just answer another question first, because actually somebody asked, what's one company that you guys have invested in that hasn't achieved the kind of success it wanted? And it's a legal tech business, because I just really like the founder, and I so want, it's been okay successful, but not massively successful. Interesting. The one thing I'd say is do your research, right?
Which one? Which legal tech?
I'm not going to go there. Well, no, they're good. I mean, they're doing well. I mean, they're like 5 million of ARR, but we've been in there for like, God, 6, 7 years, something like that. It's a good outcome, but it's never going to be the great outcome. I think what I would, if I'm telling you what to do, like, reference the hell out of the VCs before you go into the meeting, right? You know there are certain that you just shouldn't touch with a very long stick, you know, and most people know who they are. So have you done your referencing on them? Do you know how big their fund is? Do you know what their investment strategy is? Do you know what stage of the life cycle, their fund cycle they're in? So for example, if you come to us for investment right now, we're doing our last investments, 1 or 2 investments at Fund 4. That's a really bad time for a seed stage company to be taking money from a Series A focused fund, because we're almost 4 years in and we've only got another 6 years until that fund matures. So I just urge you to think about that, and then think about, if you can identify who's in which individual portfolios. So if you think about a fund like us or CCAP, right? I think they're on their 5th vintage. So they've got a Fund 1, a Fund 2, a Fund 3, a Fund 4, and a Fund 5. And there's different companies in each one of those. Which fund are you're going to be talking to their most recent fund? Who's the cohort? You know, who are you going to be comparing yourself with? So when you think about future capital allocations, you know, who are you competing with? And that's another really important point to know, the stage of the cycle you're going into a fund at. I don't know if that really helps you. It's a good question. Yeah, just do your research.
Cool, thank you. Aaron. Oh, you're on mute, Aaron.
Hi, Aaron. Yeah, you're still on mute.
Hi, yes, yeah, sorry. We are going into a fashion e-commerce marketplace business. We're raising $500,000, and we already have an angel committed for 100K. So how would you look at this perspective if I'm coming and pitching to you, having an angel already committed to a business?
Great.
How would you take that?
It's very good at this stage, especially if that as an angel, let's say it's the founder of Farfetch, right? It's like, we're in. It is honestly social signals in these kind of things, and we are driven by the fear of missing out. So I don't know who that angel is, but if that angel was somebody who's got real experience in your space, who has clout, who's done it before, that's a massive signal for us, massive signal at this super early stage. So we think about, at the super early stage, we think about, is this a founder? I mean, I can tell you there's 4 or 5 things, right? So as this founder, is this a repeat founder? Is it ideally 2 founders? Does one of them have a STEM background? That's really important to us at this stage. Do they have some super angels coming in alongside them? And we have a list of people that we'll say, if one of these 100 people are in, I mean, that's that's a big tick for us. Can they give us some customer references? And have they worked in a business that's really scaled before? You know, a venture-backed business. That's the kind of thing that we're looking for. So a referenceable angel is a really strong signal. I mean, I wouldn't base my entire, pitch around that, but it's good evidence.
And also another question is, if how soon do you close a round? Yeah.
Well, that really depends. I mean, I think when we're doing the super early stage, like 50K check, we're a follower. We're not setting terms. So I mean, it could be 3 or 4 weeks, maybe less than that. If we're leading around at like 5 million, it's longer, but it's not terribly long. Might be an 8-week process, unless it's a German company, in which case it probably takes even longer. Typically the relationship will have happened like in the 3 to 6 months beforehand. And so I think one of the things that and maybe this is to say, to go back to Luciana and others, you do, I can't remember, was that who asked the question about, should I build the relationship with the VCs before you start to pitch? We're far better off, just teasing people along and say, oh, by the way, I've just got this amazing angel investor. It's really, really exciting. I'll get back to you when I'm ready to raise. And use that way to kind of get, you wouldn't believe the feeding frenzy that happens when somebody turns around and one of the company we're looking at and we'll say, oh shit, they've got, Crandon, we're going to offer a term sheet. And we just all get all this social proof just kind of goes, all the fact finding goes out the window, right?
So one last question.
Sorry, Arun, we're really tight on time, so I want to give a few other people a few chances, but appreciate the 2 questions. Okay, really quickly, we're going to take a question from the chat. Riza asked,
just got somebody at the front door. It's not the passport office, I doubt. But
okay, no problem. Okay, everyone, heads up where we're at. We're going to take about 2 or 3 more questions. We have Hugo already here. And then, so we'll flow straight into the investor pitch afterwards. So have your questions prepared for that session.
Sorry, I've just got somebody come to pick something up. Perils are working from home and I'm the only one here. But
no problem.
I can carry on.
Just for everyone and for Hugo's benefit, who's just shown up. So Hugo is leading the next session. Hugo, we're just finishing up with a few more questions on this session, and then we will make a quick intro to you. So just keep yourself on mute, and then we'll come and say hello in a few minutes.
Right.
Okay, so ready for a question? Okay, so Riza's question was, does the age of the founder play a role in your decision? Oh, you're so multitasking, I see in the package. Okay, for everyone's heads up, we'll take this one and then we'll do Kristen and Alexandra, and then we will need to move on to Hugo.
In here.
Yeah, my question was, do you normally follow or do you normally lead?
Lead. And at the early stage, super early stage, angel stage, we're a follower. At a Series A, we're a leader.
Kristen, do you want to ask your question?
Yeah, thanks. So you mentioned how important it is to research and qualify VCs. If for whatever reason you find something that makes it seem like it's not a good fit, what is a graceful way to exit like the conversation or a scheduled meeting?
Oh, that's a good question. I mean, I suppose that's the same as any others. I mean, I don't think I honestly wouldn't overthink it. I'd probably just say, you could use it to your benefit and say, I'm sorry, we're right in the middle of some really interesting negotiations with some other VCs. I'm going to have to postpone this meeting. That will drive them up the wall. So you could have fun with that, I think.
That makes a lot of sense. Thank you so much.
That's all right, pleasure.
Alexandra, do you want to get your question in?
Yes, thank you. Hi. What would be your advice for when you're basically ticking all the boxes, but you're still getting a no with sort of the reply of, oh, but it's just a prototype? Because we do have lots of personal verification calls. So I do ask all the questions of, why did you buy this? What are your current other solutions? All that stuff. We have pre-orders. We have a working prototype, and the app is also in development. But still, even from pre-seed investors, it's like, oh, but that's too early, and you haven't proven the product yet. And I'm like, I have pre-orders. I have literally people putting money in my bank account. So like, what else do you need?
Oh God, fickle people. Okay. I would. Is there any way you can execute bootstrapped and just honestly? And if I was starting a business like another business today, I would not raise venture money.
Okay.
I wouldn't. Unless it was something that absolutely needed it, I would far rather build a business that got to 10 million of ARR and owning 90%.
Totally agree. But if you don't have the money to keep going yourself, then
so I would then I'd probably focus. It depends on what your ambitions are, right? If you're you want to build a business with hundreds of millions of revenue, then you need to find a way to kind of crack through that. Angel investment is probably the way to go in that kind of instance, and just focus on that kind of super early stage investor who's willing to commit to something where there's less kind of commercial evidence or whatever, without seeing the deck. I mean, I'm more than happy to take a look if you want me to kind of give some feedback. That's probably the easiest way to go about it.
We had a quick question that we asked you when you were picking up your parcel, which was whether.
And the passport office hung up on me, so just.
I was wondering I was worried that you left your mobile in the other room, and they were like, "Talk to you." Does age matter? Age of the founders to you?
Oh God, that's such a good question. It probably being the oldest person on the call, I can probably say. Yes, in so much as actually there's more of a correlation with late in B2B with older founders, right? They tend to be in their 40s. And this is just a ridiculous generalization, because I mean we've just had a unicorn created in paddle. I'm sure you've heard of. I mean they started that business when they were 17. I mean, so like there's always exceptions that prove the rule, but on the whole, I think the data shows that it's like 41 or 42 for a B2B, and it's younger for a B2C company, and I think it's younger typically for gaming companies, and it's not completely. I was going to say younger for Web3 and crypto and blockchain, but that's not necessarily true, to be honest. I'd like to think we're pretty blind to it. I'd hope so.
That's good. I'm gonna, Ajit, do you want to ask your question, because you're the last one, and then we'll get through it really quickly.
Yes. So my question is, hi. My question is, you did mention about previous experience or success as a founder. How significant is that criteria?
Yeah, it is.
Say, for example, everything else is fine, but there is no evidence of proving something in the past.
Yeah, I mean that's I mean you can't create something out of nothing, but possibly you could by, well, do you know what? I've got this co-founder who has got that kind of experience, or when I'm building the team, I'm going to be looking to hire if I can, I say the product leader or the devs or the engineers who've had that kind of scaling experience. I find ways to surround yourself, whether it's angels or people you're going to hire or co-founders who have proven experience. I'm not saying that is necessarily a means to an end, an absolute must-have for any business to be successful. What I'm saying is the signals that allow us to de-risk it, because we're doing lots of investments with very little data, would lend us towards people who've done this before. And the more you can demonstrate that directly or indirectly through other people you're working with, the better.
Thank you so much,
Thank
Stephen.
you.
Quick one, if people want to find you, follow up, what should they do? LinkedIn, Twitter, email?
Twitter, no. LinkedIn or email is fine. Yeah, you'll find me on LinkedIn, of course, and feel free to pass my email out. That's fine. And happy to do any kind of follow-up. I think, are there any other? There were quite a few questions on the chat, and I think actually we've gone through most of those. Any last questions, or are we done? I hope that was useful.
Yeah, thank you so much. That was really useful. And anyone that does have any specific follow-up, we will, so you're happy, we'll just put your email address in the chat here and a link to your LinkedIn profile, so anyone can just ask directly. Otherwise, thank you so much.
Pleasure.
Everyone say goodbye to Stephen, and we'll move on to the next part of the session.
Thanks, Stephen.
I go back to the passport office.
Yeah, I hope that goes well.
Thank you.
Take care.
Bye.
So for this part of the session, I'm actually just going to pause the recording.